Delaware Financial Services. Good to be with you this month. I'm here with Jason Jacoby, and we're here to give you a market update for the month of April.
Hey, so how about that NCAA tournament? I know last time we talked, you were talking a little bit of trash to everybody about USC.
Well, SC hit that three-pointer to beat UCLA. That was massive. And then UCLA went on to go further in the tournament than SC, and but the Pac-12 actually ended up, they looked pretty solid, yeah. But
absolutely.
Congrats to those Baylor Bears, man. They put it to Gonzaga, and yeah.
I'd say so.
Yeah,
pretty good game.
Quite a good game. So anyway, good to have some sports back. Good to be kind of up and running a little bit more now with the opening COVID. Things are kind of opening up again. It's spring has sprung. We're ready to go, right?
It has.
So it's exciting. So
my golf swing still hasn't, but good Masters last weekend. Congrats to Hideki Matsuyama for winning that.
That was huge.
It's great.
Big win for that guy. That guy's going to be famous in Japan, right?
And we need to manage his money. I don't know.
Yeah. They need some help there, so that's good.
Absolutely. Well, all right. Well, let's dive right in. So year-to-date market update for the last 4 months or so. S&P 500 9.92%. So tracking a little bit under their averages here over 10 years, and Nasdaq 7.85%, and then followed up by the Dow Jones, which is the highest of all three right now, 10.44% year to date.
Yeah.
Even since the time of last recording here, it's jumped above the Nasdaq year to date.
Yeah, I think that last time we talked about our last presentation, we talked about volatility and the fact that the Nasdaq actually went down 10%.
Yeah.
We were right on in regards to expecting some volatility to pick up. It was ironic. The Nasdaq actually literally went down almost exactly 10%, and when it hit it, it bounced right back up. Mm-hmm. It's sort of been going sideways here for a while. Kind of found the midpoint, trending along some lines there. But again, good moves by that, and we think that looking forward, the Nasdaq seems to be a place where there's probably some potential growth, but we'll cover that a little bit later here. But
absolutely.
Anyway, yeah, it's good so far. Good in the markets. April actually tends to be typically a solid month every year, going into the doldrums of the summer. So anyway, we expect it to be decent in here right now, and markets are holding up strong.
Good. All right, well, let's dive right in here. So starting with U.S. GDP. So last time we talked, we were at 5 to 5.5% for 2021 GDP growth, right? Economy's reopening, things are getting back to normal. And we're revising that again. We're actually increasing our GDP. For
6.25 to 6.75. So GDP looks to be really kicking in. Stimulus, Fed, the Fed is pretty easy on interest rates still, and then just the opening of, with COVID and vaccinations, things like that, people are biting at the bit to get out and resume life as normal it was, over a year ago. So anyway, that's why we feel like the GDP numbers should be ratcheted up a little bit.
Now, speaking of that, things reopening, inflationary pressures, right? Interest rates are starting to rise. Our predictions and projections for the 10-year Treasury yield are actually increasing to 1.75% to 2% from our previous predictions of 1.25% to 1.75%.
Yeah. So rates at 10-year Treasury, they went up, hit about that 1.75%, and then came back down and have been sitting there. But we feel like with stimulus and all this, the potential for GDP to pick up, that we could get some higher interest rates into the rest of this year. So absolutely. I think that's a wise way to look at it, and that's why we're kind of ratcheting that up that way.
So speaking of investments, this is the fun part. We always talk, you and I in the office about this. So it's kind of fun to bring in an audience here as we discuss what we look at, what's hot, what's not. So kind of getting into this a little bit. Are we still favoring equities over fixed income, especially with these rising interest rates and having bond-heavy portfolio? If you could just break that down a little bit.
Yeah. So I think absolutely, we definitely we recommend equities over fixed income at the moment. Like we talked about last time, anytime interest rates are in an upward momentum, it's a headwind to fixed income.
Okay.
And so, if we're looking for total return, probably equities look pretty good, especially on the value side with paying dividends and so forth. So, But that's not why you always have fixed income in your portfolio. Rising rates, we also get higher coupons. That's positive. And again, like we said last time, it's good that we're getting some growth here. So that's actually positive. But I think anybody's portfolio has to take kind of a specific approach to making sure that your risk tolerances,
Absolutely.
we fit that risk tolerance and that it's all kind of working together. So in most cases, though, if we're not too risk adverse, we might recommend picking more equities over fixed income for sure.
Speaking of equities, what are some of our favorite sectors at this point? Things are sometimes on an upward trend. Some things might be out of favor. Obviously, with growth stocks, things have been kind of on fire, like we talked about. NASDAQ, the tech-heavy, the growth-oriented stocks were on a tear since last year, up over, I believe it was over 89% over the last
Crazy.
year.
Yeah.
But then, like we talked about, had a little correction of over 10% and then bounced back up.
Yeah.
Which then transferred to the value side of things. So there's specific sectors that are kind of on the upward trajectory and trend right now.
Well, like we said last time, we thought there was rotation going on in the markets. Big growth last year, like you mentioned, and now the value side has really started to rotate, and we've seen that. That's why the Dow and the Dow is above the NASDAQ year to date, because you're getting more people looking for those value sectors to be good. So we like financials. Financials. I think the interest rates help the financial sector. That's really been on a tear. Materials groups. Anything that economic as it picks up. That bricks and mortar kind of stuff is always positive. And so we like those areas, and yet still like growth. I mean, I still feel like the large cap, especially, the earnings on these companies are, continue to be ongoing, and so I think it looks strong too. So so there's some real positives in there, and some places that we like.
Great, awesome. Now talking about with every return, there's a risk involved, right? Risk return ratio, like you had talked about prior to, make sure that your portfolio is tailored to your risk tolerance, your goals, your financial plan that we create. But what are some near-term risks that we're seeing in portfolios right now, or in economic activity that might hinder the markets moving forward?
Yeah, I think the further increases in interest rates. I think that's we just ratcheting up our estimates on interest rates. I mean, if we had a faster increase, that's a risk to the economy.
Mm-hmm.
I think that's it. I think possibly COVID-19. There's some things, even though vaccines have passed out, we're talking about and hearing about variants and different things that could happen there that could cause further shutdowns possibly in the future. And also under the Biden administration now, you're hearing a lot more about tax increases, which never like to pay taxes, so I'm not for that at all. But the reality is, under this administration, they're looking to do that. That's probably not going to be until 2022, but the fact is those are all kind of near-term risks. But again, the markets, got to remember that the markets are always factoring in some of these things that are being, on headlines and news, right? Correct. So it's the things that surprise the market that cause the big steep sell-offs or whatever, or just basic pullbacks that are healthy for a market. But a lot of these things are already kind of cooked in the books, you can say, in a part of that. So but there are those risks, and with a Democratic controlled Congress and sort of the Democrats sort of in control at the moment, there's some risk. I mean, wherever you are politically, there's some risk as to overreaching on a particular side that can be a risk as well. But anyway,
can we? So going into the tax thing a little bit more. Love what you said. How does the tax increases potentially affect inflation, supply side inflation? So if taxes increase, as the corporations aren't just going to pick that up on their books, right? They're going to pass that along to the consumer. Right? So,
and that's why tax increases are not good. Corporations are always going to pass those things on, so that causes inflation. Prices will go up because the consumer is the one that's going to eventually pay for that. So, that's why politicians have to be careful of what they do. Can't willy-nilly things. There's a cause and effect to everything, so you got to be careful with those.
Absolutely. So if we're talking to fixed income aspects, we're talking about interest rates, inflation. the Fed, Jerome Powell, obviously being more accommodative still at this point. Is there a specific duration of bonds in a portfolio at this point that we maybe favor? What does that look like at this point in the fixed income environment?
Well, anytime, so duration is a way in fixed income is to try to, the longer you're out, the more risk you're taking on with rising rates. So I think shorter duration bonds, those are the places that I know our managers that we have lots of our resources with, are looking to lower duration and find lower credit risk with quality companies. Not big on treasuries right now, but there are opportunities in the banking with fixed income there. That's some real positives too. And so yeah, just in those ways to manage that. But interest rates cause, again, they just cause issues with fixed income. And so that's why we're trying on a case-by-case basis, making sure that, again, balancing risk tolerance with our portfolios is really important at this time of the year. And we feel like we got great managers at the Capital Group, different people that we put our resources with. So feel good about that. But it is, like I said, it's we've had a 40-year trend of down interest rates coming down. It's way before you were born. I mean, I remember, interest rates at over 12%. You could get CDs at 12+%, which was crazy. And so we've had all this time, the interest rates have come down, and it's been great for fixed income. But if we find a place, and we're not looking for them to go up crazy, but at the same time, if we get, we came down so low that, again, it's going to be, especially in the near term here, a little bit of a headwind to the fixed income. But still feel like they're a place for them. It's like, if you ever heard, it's like, a bad year in the bond market is a bad day in the stock market, right? So even though we feel like bonds, I might be, hey, I'm not making money in bonds, it's still, we have our fixed income in there for lots of other reasons other than growth. It's for stability, it's for, when stocks and bonds, that inverse relationship, it's for risk. Like I said, lots of reasons to keep it in there. But again, case by case, and if you have questions about those, feel free to make sure you talk to us about it if you're concerned in that area.
Absolutely. Well, any final words? I know we kind of went over a lot. There's a lot of meat in there, I think, that our clients will enjoy. But anything else we want to leave off with?
Yeah, I mean, I talk to clients a lot about the fact that, like, international, I mean, we still like emerging markets. Feel like the larger international piece is still Europe. Some things are still dealing with COVID. Maybe not be great, but we still feel like emerging markets in some of these areas are positive. So I feel like we always have to have a international component in our portfolios, and that's what we've been doing. So that's great. And again, I would just say, continue, call us if there's questions, if you have anxiety, whatever. We're here to help walk you through. The worst thing people can do is try to make big bets in any direction at the moment. Stay allocated. Keep a well-balanced game plan. It's always key. It's kind of our fundamentals here at Boyer Financial Services. We believe in having an all-weather portfolio and staying diversified and sticking with the plan. That's important to do. So feel comfortable with where we are and continue to look for opportunities to further enhance our clients so that they're good stewards of the money that God's given them. So we feel like we're a part of that and excited to be a part of that on this team.
Wonderful. Well, thanks so much for joining us this month. I know Mark and I really appreciate everything that you guys stand for and that you do for us, and we love to serve you guys. Again, if you have any questions, feel free to reach out, call, text, email. We're here for you. But for this month's Boyer Brief, I'm Jason Jacoby.
And I'm Mark Boyer.